Have you ever considered investing in private credit? It's a fascinating area of finance that you might not be familiar with, but it's definitely worth your attention. Let's dive right in and get to know what private credit is all about. Essentially, it's a type of investment that involves lending to companies outside the traditional banking channels. You're essentially stepping into the shoes of a bank, providing loans to mid-sized firms that may not have access to traditional forms of credit. Platforms like Wealthsimple have made it possible for individuals to venture into private credit, provided they have a minimum deposit of $100,000. This type of investment is typically focused on senior secured loans, steering clear of high-risk private equity deals. So you're not just throwing your money into a black hole, you're providing vital support to businesses with a solid foundation. Now you might be wondering, how does private credit stack up against other investment options? When it comes to investing, choices abound. So how does private credit compare to, say, private equity? Private credit and private equity are two significant players in the investment arena. Both are distinct in their operations and offer unique opportunities for investors. But how do they stack up against each other, especially in terms of returns? Let's dive in. According to a recent BNN Bloomberg article, private credit funds are currently outperforming private equity funds. In the second quarter of 2023, private debt funds returned a solid 2.61% to investors, while buyout funds, a type of private equity, lagged slightly behind at 2.29%. Now, what's driving this success for private credit? A couple of factors come into play. Firstly, private credit enjoys a certain level of protection against interest rate fluctuations, a feature that's particularly appealing in an uncertain economic landscape. Secondly, the buyout market, a key arena for private equity, has been facing its share of challenges, indirectly bolstering the appeal of private credit. On the flip side, private equity is navigating a few hurdles of its own. The industry is grappling with concerns about an asset bubble in the private credit space. This, coupled with challenges in returning cash to investors, has had an impact on private equity's performance. Fundraising for both private debt and equity markets has seen a slowdown, with private debt attracting more capital recently. Private equity firms are also facing challenges in exiting businesses and returning capital to investors, leading to a decline in available funds for deals. This situation has created a somewhat more challenging environment for private equity, at least for now. As you can see, while both private credit and private equity have their pros and cons, private credit is currently outperforming private equity in terms of returns. It's a fascinating landscape, and it'll be interesting to see how the dynamics between private credit and private equity evolve in the future. However, as with any investment, private credit is not without its risks. Let's dive into some of these potential pitfalls. Firstly, there's the risk of potential loss. If the borrower defaults on their payments, the investor stands to lose their investment. Then, there's the unpredictability of market fluctuations. Economic conditions can change rapidly, and this could affect the performance of the investment. For instance, a downturn in the economy could lead to higher default rates, impacting the returns from private credit investments. Leverage is another risk factor. While it can amplify returns, it can also magnify losses. If the borrowed funds used for investing result in a loss, the investor will still be obligated to repay the borrowed amount, further deepening the loss. Lastly, there's the issue of liquidity. Private credit investments are not as easily convertible into cash as public market investments. This could be a significant concern if the investor needs to access their funds quickly. Remember, all investments carry some degree of risk, and potential investors should carefully consider their risk tolerance and investment objectives before diving in. So, while private credit is an exciting investment option with potentially higher returns, it's crucial to understand the risks involved. So, we've explored the world of private credit, compared it with private equity, and looked at the potential risks. Let's summarize. We've learned that private credit involves providing loans to medium-sized companies, bypassing traditional high-risk private equity deals. This investment strategy, as we've seen, targets a yield of around 9% and is led by seasoned managers aiming for monthly income and historically higher returns compared to private credit. We've also discovered that private credit is currently outperforming private equity in terms of returns. Despite the success, it's important to remember that this form of investment carries inherent risks, including potential loss, market fluctuations, leverage, and liquidity issues. We've seen that the private equity industry is facing challenges in exiting businesses and returning capital to investors, leading to a decline in available funds for deals. Meanwhile, private credit has been attracting more capital. Whether private credit is right for you depends on your individual circumstances and investment goals. The monthly distribution and higher yield is definitely something that interests me. As always, it's best to do your own research before making any investment decisions.